are going to cover the top 10 things that you need to know about the new tax law. And this is obviously very subjective, but I think we can feel pretty good about what number one is. And number one is going to be the 20% so-called pass-through deduction of Section 199A. Reason this is so big is that for small business owners, for pass-through owners, for Schedule C and Schedule F filers, this is what's going to give you a pleasant surprise when you file your returns. It will unfortunately also give many of you an unpleasant surprise when you get your bill from your tax preparer, because it is not the simplest thing in the world. Section 199A, this so-called pass-through deduction, provides deduction of 20% of qualified business income. You hear it called QBI a lot. The effect of this is to make QBI 20% tax exempt. The deduction is available for trader business income that's taxable on 1040s, whether it's from a K1, a Schedule C, a Schedule E, or a Schedule F. Initially, a lot of people thought that you needed to set up some kind of pass-through entity like a partnership to claim this. That's not true. But it's complicated, and this deduction is subject to a number of important limits. In order to qualify for this deduction, you have to have eligible income. It has to be QBI, and it's income expense of a qualified trader business during the year. It includes qualified REIT dividends, real estate investment trust, and qualified publicly traded partnership income. It, however, excludes specified services, which includes what I do for a living, what lawyers do for a living, what doctors do, consultants, athletes, stockbrokers, commodities dealers, people who deal in securities. And then there's this other thing. It's a trader business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. That scared us all when it first came out, because that pretty much applies to everything if you really think about it. But fortunately, that's been restricted to a very narrow definition, which we'll talk about in a minute. These restrictions on specified services don't apply when income is below a threshold amount that we'll get to. And architects and engineers also are not specified services, so whatever they earn, their pass-through income will qualify. Non-qualifying income includes capital gains and losses, dividends other than qualified REIT dividends, interest other than trader business interest, financial institution interest income on a K1 does qualify, commodity gains other than trader business income, non-hedging currency and derivative gains, and annuity income. Also not qualifying are W-2 wages and guaranteed payments on the K1 of a partnership for partners. Rental income itself is not included in this list of exclusions, but under the regulations that have come out, many lease arrangements, such as triple net leases, may fail to rise to the level of a trader business and therefore fail to qualify for the 20% deduction. So-called Section 1231 gains that are taxed as capital gains on equipment sales also fail to qualify for this exclusion. Some other limits that apply. If a taxpayer has taxable income above threshold amounts, the deduction is limited to the greater of half of W-2 wages that are incurred in trades or business of the taxpayers that are generating that income, or the sum of 25% of those W-2 wages and 2.5% of the taxpayer's unadjusted basis in qualified property. Qualified property is depreciable property held by the business at the end of the taxable year and whose depreciable life has not expired by the end of the taxable year. For this purpose only, the depreciable life of a property is the property's regular tax life, but no less than 10 years. Where did this come in? Well, lot of real estate businesses don't generate a lot of W-2 wage expense. And so this enables real estate rental businesses to participate more fully in this deduction. Okay, what is this depreciable basis that we're talking about? Well, the buzzword is UBIA, and it's got to be tangible depreciable property, so intangibles don't qualify. It has to be held at the end of the taxable year. Many basis adjustments pursuant to Section 754 elections of partners don't qualify. Bonus depreciation does not affect this, so you can take bonus depreciation all you want, and you don't have to worry about reducing your pass-through deduction if you're relying on that basis. You can use it for up to 10 years. And now I'm going to point out one thing where there's an error in the slide because it relies on the old regulations. Carryover basis rules for non-recognition transactions. Initially, they were going to reduce that to the basis at the time it went into a corporation in a tax-free contribution or a partnership in a tax-free contribution. Now that basis for this purpose will carry over. So that slide is incorrect. Okay, now we get to the key, the threshold amounts. As you'll recall, specified service income does not qualify for the 20% deduction. However, it does if it's below a certain threshold amount. Also, you have to be paying W-2 wages or have basis in tangible property in order to qualify under this whole UBIA thing. And that also does not apply when you don't have income over the threshold amounts. And these threshold amounts are pretty generous. For unmarried taxpayers and separate filers, you don't have to worry about either the W-2 thing or the specified service income if your adjusted taxable income is up to $157,500. And then the deduction phases out over the next $50,000 of income. If you're a joint filer, you're good up to $315,000 of income phasing out over the next $100,000. These tests are applied at the individual level for partners, and S corporation shareholders. So what does that mean? That means if you are, for example, a Schedule C attorney and you're married and your joint adjusted taxable income is $300,000 from the Schedule C, and that's all you have, you can exclude 20% of this under this 199A QBI deduction. So now we'll go to our first polling question.
Qualifying income excludes, and then you have your multiple choices there.
And that is correct. Well, the statement B is also correct. It's sort of a red herring and doesn't answer the question really, but A and C are correct. Qualifying income does not include annuity income or commodity gains other than trade or business income, which leads to the question, when could commodity gain be trade or business income? There you'd primarily see that if you were, for example, a farmer that was doing some hedging, then that potentially could be trade or business income. Moving on here, we will go to item number 2, state and local taxes. The new tax law repeals the itemized deduction for state and local taxes, including income and property taxes, effective after 2017, with the exception of a $10,000 annual allowance. So it's the maximum deduction for income taxes or at the taxpayer's option, property or sales taxes. This means that a great many of taxpayers will be capped out at $10,000 for their potential itemized deduction for state and local taxes. One thing that's unusual about this is it's the same $10,000 limit for joint filers and single taxpayers. So it sort of balances out the QBI, because the QBI threshold to avoid a lot of the limits is $315,000. for joint filers versus 157.5 for single filers, that would encourage somebody to make a commitment. This might send somebody the other way. Now, several states have enacted schemes to work around the SALT limit deduction. These are states that have universally high tax rates. They're high tax states: New York, New Jersey, California. They do not like this SALT cap. So they've enacted a proposed donation schemes. Taxpayers would, quote, donate to the state and get 100% credit against their state income taxes for their so-called charitable contribution. The goal is basically to move this deduction from the capped $10,000 state and local tax limit over to the uncapped charitable deduction. This has been passed in New York, New Jersey, Connecticut, and Oregon. Needless to say, the IRS has not been pleased with this, and it's also been proposed in a number of other states. The IRS came out with an announcement saying, hey, we aren't going to allow this, and then in August they came out with proposed regulations. Interesting about this is that they only apply to donations made after August 27, 2018. That means during the brief window between when this got enacted by some states and when it was passed, these schemes actually worked. But now any additional so-called donations no longer work. The other issue is that any credit that's given on state taxes for these so-called donations that is over 15% of the so-called donation amount will reduce the charitable deduction allowed. Now, here comes the real kicker. This limit doesn't just apply to these schemes passed to work around the $10,000 state and local tax cap. Other state tax credits are affected. Many states, including Iowa, award tax credits for contributions to funds for tuition assistance for private schools. Other states award credits for other types of donations. These are all potentially affected by these new rules. So we will now go to polling question number 2.
All right, polling question number 2 is a true or false. And the second poll is now open.
Very true. It's going to be interesting keeping track of this. A lot of these credits were oversubscribed, and so the donations were made in a prior year, but the donations aren't available under the given state's cap for these things until future years. And it appears that those donations will qualify. And so if you get a credit against state taxes, like in Iowa, it's 65% of the donation amount, you can still take the full charitable deduction. But for donations made to these state tuition, school tuition organizations after August 27th of 2018, you're going to have to reduce your federal charitable deduction by 65% of the amount of the deduction to take into account the state tax credit. There we go. Now we go to item number 3, and this is qualified opportunity zone incentives. Now, this is something that probably is not affecting the tax return that you're working on right now, but this is going to be a big deal. The way this works is it's a way to roll over and defer capital gains by reinvesting them in a so-called qualified opportunity zone through a qualified opportunity fund. Only the gain amount needs to be reinvested, not the entire proceeds from the sale. This is potentially a lot more attractive to a taxpayer. If you do a like-kind exchange, for example, you generally have to roll over pretty much the whole value of the property that you sold into the new property in order to defer the gain. Here, you only have to defer the actual gain amount, which could be a lot smaller than the entire proceeds. The potential benefits, and these are elective, they're not mandatory, are you can defer gain from the sale of prior investments to the extent of the amount invested in a qualified opportunity fund, as long as you do so within 180 days of the date of the sale or exchange of your gain property. This gain is deferred until the earlier of the disposition of your investment in the qualified opportunity fund or December 31st, 2026. So that'll be a big date on a lot of people's tax calendars. If you hold the property for at least 5 years, you get to reduce 10% of the gain on that deferred amount. If you hold it for at least 7 years before you sell it, your original gain is reduced by 15%. This is done by increasing the basis of the property that you've rolled into, or basically increasing the basis of your QOF investment. Furthermore, if you hold your QOF investment at least 10 years, not only do you get to defer and perhaps reduce the gain from your original sale, any gain that accrues in your investment after you roll it into the QOF fund could be excluded forever. So you get to defer and reduce your original gain, and then if you have any additional gain because the fund does well, that gain can be entirely tax-free if you hold it long enough. Examples here. Here we have somebody reinvesting $10,000 of gain in a qualified opportunity fund in 2018 within 180 days of the sale or exchange. If you hold it for 5 years and you sell the investment in 2023 for $15,000, you recognize 9,000 of the deferred gain. In other words, you get to reduce the original gain that you deferred by 10%. And you recognize 5,000 gain at that point from your appreciation of the investment since you made it in the QOF. Now, if you hold that for 10 years and sell it for $18,000, your deferred gain is only taxed, your 10,000 of deferred gain is only taxed to the extent of 8,500 because you get that 15% reduction. Plus, you pay tax on that $8,000 of additional gain that's accrued since your original $10,000 investment. Now you hold that for 10 years, not only do you get that full 15% reduction of your original 10,000 gain, but you pay no tax on that additional $15,000 gain that accrued after you made your initial investment. So that can be a pretty attractive thing. But you got to be careful. There are still significant uncertainties even after the first round of IRS guidance. The statute applies rules that require qualifying opportunity funds to do most of their business in the zone, but it's not clear what it means to do most of your business in the zone. They haven't really come out with sourcing rules. Other questions relate to how specific types of investment will be treated. There's certain investments that don't qualify. For example, liquor stores, golf courses, and other so-called sin businesses are not eligible for qualified opportunity zone investments. Still, there is great potential for taxpayers who have some gains to defer. If you look at a map of these funds, you find these all over. Most metro areas will be largely qualifying opportunity zones where you can make these investments. As the IRS resolves the questions on these, I expect there to be a cottage industry growing up, helping people reinvest and find investment opportunities in these qualifying opportunity zones. Also, if you find the right investment, you don't need to work with a third party. Everybody can set up their own qualifying opportunity fund simply by filing an IRS form. So there's a lot of opportunity. Still, what it means is you have to basically invest in a property or a business in order to qualify for this deferral. There are often safer ways to offset capital gains, such as selling lost stocks out of your portfolio that are easier, but there's going to be a lot of opportunities for people, a lot of interest in this as people figure out these provisions. The IRS provides more guidance, and there's a greater knowledge of how to get these things done. So, polling question number 3. Yes, there is great potential for taxpayers who have some gains to defer. And yes, there are often safer ways to reduce or defer capital gains. Now we will move on to item number 4, business loss limits. This one is going to be a big surprise to a lot of people who are in the venture capital in business. This restricts the current use of so-called excess business loss of individuals to $250,000 or $500,000 on joint returns starting in 2018. Are wages business income for this purpose? IRS guidance so far says yes. The Joint Committee Blue Book, which is Congress second-guessing itself after they actually sit down and read what they've done, said that they didn't mean to do that. But IRS says, as the law is written now, wages are business income. This is an important deal for people who have, say, big partnership losses that they use against other investment income. There have always been 3 hurdles that people with business losses coming through from partnerships or S corporations have had to clear. They've had to have basis in their investment. That basis has had to be at-risk basis, and they have to be non-passive. Now, even if you pass all those things, if you're single, your loss is restricted to $250,000, or if you're filing a joint return, your loss is restricted to $500,000 of ability to offset other income. And that's done on its based on all of your losses for the year, all of your business income. So if you have $1 million loss on a K1 and then $1 million of income from another K1, you're fine. But if you have $1 million loss on your only K1 and you have $1 million of interest income, you're going to be paying tax on $500,000. Moving on to number 5, limitation on business interest. This one is going to be very big going forward, and it's got a lot of surprising effects right now. In general, the deduction for interest paid for a business can not exceed the sum of the taxpayer's business interest income for the tax year, plus 30% of the taxpayer's adjusted taxable income for the tax year, plus the taxpayer's floor plan financing interest for the year. And that's a dealer provision. This differs from the old law, and under the old law, there were really no specific limits on the deduction of business interest for any given year. That provided a lot of incentive for people to do debt financing versus equity financing, and this limit is designed to reduce the advantage of business of borrowing for business financing. Where does it apply? Normally, the limitation applies at each taxpayer level. For an affiliated group of corporations filing a consolidated return, it files at the consolidated return level. For partnerships and S corporations, it applies first at the entity level. And then if you have some excess income, then it can also apply at the taxpayer level. It's important to note that there's no grandfathering of existing debt. It applies from December 31st going forward, no matter how leveraged up you were, no matter how much you relied on the old tax law for the debt that you had. So it's kind of a surprise for a lot of structures. Business interest is any interest paid or accrued that's allocable to a trade or business, and it includes any amount treated as interest under the code for purposes of this limitation. Under the regulations, the definition of interest is expanded to a lot of financing costs so that people don't try to avoid this through the use of loan fees. Those are very controversial, and some people think that those rules exceed the IRS's authority, but that's the way the rules are written right now. Business interest income is the amount of interest includable in taxpayers' gross income that's allocable to a trade or business, does not include investment in tax-free munis, does not include, these limits do not apply to investment interest expense, for example, margin interest used to buy stocks, and you don't get to qualify interest on your personal portfolio for bonds to increase your deduction of business interest. Here is a deceptive but important exclusion for small businesses. Businesses under $25 million in sales are normally exempt from these limits, but this exemption doesn't apply to syndicates. Basically, any business that has a loss and allocates more than 35% of its loss to passive investors is considered a syndicate for this purpose. So this would cover, for example, a business equally owned by 4 siblings, 2 of whom are active. Not an uncommon situation, certainly in the farm world. So this is going to apply to a lot of taxpayers who are under 25 million for this reason. This $25 million limit is also applied on a controlled group basis. So somebody who has a large business can't chop it up into different entities and avoid the limits. There are some exclusions from this. Vehicle dealerships are generally exempt for this to the extent of their floor plan interest, and farm and real estates can exempt themselves from these limits optionally. But all of these exemptions come with limitations on depreciation allowances of varying severity, which for vehicle dealerships with lease fleets, not being able to take bonus depreciation, which this requires, is a very severe restriction. For farms and real estate, it's for property up to 10 years, a lot less significant for them. This limit initially is done, is less severe in the early years, because right now the adjusted taxable income is determined initially without regard to depreciation. After 2021, depreciation will be counted, and it will really have some teeth at that point. Okay, now we move on to item number 6, alimony. Under the old law, alimony was deductible to the payer and includable in recipient income. That generally worked out well for tax planning because almost by definition, the payer of alimony is going to be in a higher bracket than the recipient of alimony. Under the new law, however, alimony will be neither deductible to the payer nor includable to the recipient. The effective date is for divorce or separation instruments executed after 2018. Divorces in 2018 could be done under either set of rules, either the old rules or the new rules. So old pre-2018 agreements are grandfathered, and the alimony will remain deductible to the payers and includable to the payees. However, if for some reason the situation has changed and they want the parties agree on this, taxpayers have the option to modify existing agreements to be taxable under the new law. Of course, that has to require a divorced couple to agree on something, which has some inherent difficulties. Now we will move on to item number 7, home mortgage interest. The home mortgage interest deduction for new home acquisition debt incurred after December 15th, 2017 is reduced to $750,000. That had been $1 million before that. On a more practical basis, the home equity loan deduction, interest deduction, has been suspended from 2018 through 2025. So in other words, if you, under the old law, you could borrow up to $100,000 against your home equity, and at least for regular tax, deduct that as home mortgage interest. That is no longer the case. However, if you are borrowing to remodel, and your remodeling doesn't get your debt up to $750,000, then you can still deduct that as regular home mortgage interest. One question I get on this a lot is, well, you know, I've paid my house down, my mortgage down on my house to $100,000, but I could easily borrow another $500,000 on my equity. Can I do that and call that acquisition debt? And the answer is no. That is equity debt, and you will have no interest deduction for that. And finally, our bonus 7.1. The alternative minimum tax has been defanged. Very few individuals will have AMT under the new rules, so all that planning that you may have done in the past to avoid AMT, you don't have to worry about that anymore. That's the good news. The bad news is that the reason it works like this is that a lot of the AMT has now been moved over into the regular tax. Key item is state and local taxes. Probably more than anything else, the deduction for state and local taxes, which was not allowed for AMT at all, would throw a lot of people into alternative minimum tax. Now with that $10,000 cap, that has the effect of eliminating the state and local tax deduction for those taxpayers on their regular tax too, so they're not in AMT. Also, the new law eliminated the 2.5, all the miscellaneous itemized deductions for regular tax, things like tax prep fees, investment expenses. Those were a common AMT item, and now those are unavailable for the regular tax too. Finally, the AMT had a fairly large personal exemption. Now that's also true for the individual regular tax, which has a $12,000 personal exemption in 2018 for single filers and $24,000 for joint filers. So even that is a lot more like AMT. So good news, AMT is dead. Bad news is that everything that made AMT painful has now been moved into the regular tax system. And now we move things over to Ava.
All right, thanks, Joe. I am Ava Archibald, a principal and co-director of our Wealth Transition Services Group. So I'm going to share with you just a few things that have come about with tax reform as they pertain to the estate gift and GST tax. Okay, so what's changed with the estate tax, or with tax reform? The estate tax has not been repealed. We still have estate gift and GST tax, but the exemption is increased from where it was at 5.6 million. It is now increased. For 18, it was at 11.18 million. For 2019, it increased to 11.4 million. The rate itself has not changed. That's still at a 40% tax rate. And with estate tax being in place, we still have a stepped up tax basis for our taxpayers when they die holding assets. That's a great benefit for a majority of our citizens in the country. For those who aren't over the exemption, they have a benefit of getting a stepped up income tax basis on their assets at death. For those over the exemption, there's still planning that probably needs to be done. And with this higher exclusion amount, leaves us to have a lot of a number of different things to think about. One thing they didn't change with the new laws, they did not remove portability. That came into play in 2012. It was made permanent, and I'll touch on that in just a minute. But all these increases, the thing you want to remember is that they all go away with the sunset that we have in 2026. Our annual exclusions, they've increased for 2018 and 2019 to $15,000 per person. So what is portability? If you're not familiar with that term, that means if I die and I don't use all of my estate tax exclusion during my lifetime or at death by passing assets on, my personal representative can file an estate tax return and take my remaining exclusion and make it transferable to my surviving spouse. That originally was thought that that is going to make estate planning much simpler for a number of individuals. However, for some, it's made things a little more difficult. There's a lot more things we have to look at, especially when we have such a large exclusion amount. When we have a large exclusion amount and someone dies today with $11.4 million exclusion, if you are at that amount, is that something that you want to use that exclusion on the first death, or do I make it portable to my surviving spouse? You know, the growth one had on maybe $5 million of assets is much different than the growth on 11.4 million. So there's a lot of things we want to look at now when we have those clients who may be subject to estate tax either today or at 2026 when their exemption drops. We look at the age of the client, we look at the asset, and we want to see what is the growth that that asset might have. What's the age differential between spouses? So if I'm in my 50s today and I pass away, I expect my husband's going to live at least till his 80s or maybe 90s as life expectancy continues to grow. You know, what will that look like if I make all my assets portable to my spouse now? Or should I freeze some of that on a first death? Income tax considerations are another thing we want to look at, because with that stepped up tax basis, now, again, if I'm in my 50s and I don't think that we will ever be over the estate tax threshold, I would more than likely want to file on the first death for making my exemption portable to my spouse and let my children have a second step up when my spouse dies 20, 30 years down the road. So a lot of things we have to look at now with that higher exemption and when we have portability in play. Over the past years, especially when the exemption was lower, a lot of people have their estate plans drafted for what you might hear referred to as a credit trust or a marital trust, or a family trust and a marital trust, an AB trust. What taxpayers were doing is when their estate plan, they set a trust on the first death to use the exemption, because in years before 2012, portability wasn't allowed. So you wanted to be sure that on the first death I'd use my estate tax exemption, but maybe I didn't want my spouse to lose the income stream. So I put my assets in a trust for the exemption amount, give my husband or wife the income stream for life, and then let my assets pass to my children on the death of the second spouse. Now with portability, we might not want to fund that credit trust or family trust. Maybe we want everything to go to the spouse and let that spouse have a second stepped up tax basis. I think of my own family. We have a family farm, which will be coming my way. And for me, if I died in my 50s, I'd rather let my family farm pass to my husband and let my children get a second stepped up tax basis when the exemption is at that $11 million threshold. Now, when the threshold drops to 2026, maybe we'll be in a different place. The best thing I think people can do right now is have their documents drafted that leaves portability on the table and allows you to make some of those decisions after death when you'll have a better idea where the exemption will be. Some of those types of planning techniques may be disclaimer trusts, where I leave everything to my spouse, but if he decides he doesn't want it, he disclaims it in a trust at my death, if I died first, using my exemption. Or maybe again, if I'm in my 50s and I pass away, I might leave everything into a marital trust where the spouse gets the income for life, but my personal representative can decide how much of that trust is going to be using exemption now and how much will be subject to estate tax when my husband dies, making a portability election for just part of my exclusion. The main thing I want people to think about is leaving options on the table. So if you've had your planning documents drafted before 2012, or maybe even shortly after that, where portability came into play, now that this estate tax exemption has changed, you really might want to think about it, of revising them. The other thing I see is with these plans, when it had a trust that said, or has a document that says, on my death, everything funds as credit, trust, or family death up to the exclusion amount, that might have been okay when the exclusion was 5 million. But now with the exclusion at 11 million, some marital couples don't want all of their assets to go into trust. And if that exclusion is at a higher level, more assets are going in trust on that first death. So a lot of options and a lot of things that we want our clients to think about. Number 9 is what we want to think about with trusts right now. Planning with trusts is going to maybe cause us to stop and really think about how we want to set up trusts if we are doing our estate plan. I have many families that think about, do I want to create a pot trust if I have a number of children? Let's say we have 5 children. Should I put all my assets in one trust for my 5 children? Or should I have a separate trust for each child? And there's many reasons why you think about that. Maybe you have one child who has a creditor issue or a spending habit. Maybe you're setting up trusts for educational purposes, and you have one child who might get a doctorate at an Ivy League school, and maybe one child is going to have a 2-year education. How do you make that equal for all your children? That's a question many of our clients struggle with. Is it a pot trust or separate trust? Well, now with some of these new tax rules, it might cause you to think about having those separate trusts, like the one for the $10,000 annual allowance for real estate income tax deductions. If I had 5 trusts, I would have 5 annual exclusions, where if I have one pot, I'm only going to have 1 exclusion. For that 199A deduction that Joe talked about, if I have 5 trusts, I could get that 20% business deduction across the board here for 5 trusts versus just 1. But the things to think about with that is in 2026, a lot of these things are going away. Do I want to have these 5 trusts that I'm still going to administer just to take advantage of some of these tax benefits? And more importantly, to watch and think about is the IRS is not going to allow you to just set those trusts up just for tax avoidance. So there is a code section that specifically states that if you have multiple trusts and they're identical trusts and they're set up just to avoid tax, the IRS is going to disregard that and you're not going to get those extra benefits. But if there are other reasons on why you might have separate trusts, and our clients were maybe sitting on the fence on which way to go, these new rules might lean you one way or the other on how you make that decision. The other thing with trusts that I see and I receive a lot of questions on are irrevocable life insurance trusts, many times referred to as an ILIT. People who may have estate tax owing on a second death might want to think about, how can I reimburse my family for those expenses? And many times they use insurance. So if I own an insurance policy in my own name, payable to my children, those proceeds are taxed at my death. But if I own an insurance policy through a trust and the trustee pays the premium for that insurance policy, it can pass to my children and be outside of my estate. So many times you transfer cash. I make a gift of cash into a trust. The trust buys the insurance policy, pays the premium. On the second death, or when even a first death, if I want that cash to go to my children, it's outside of my taxable estate or the taxable estate of the couple. The proceeds in those policies, though, or some of the policies now have proceeds that are going to pay out maybe for an amount that I might not need now that the exemption is so high. If I set this trust up to pay estate tax and now the exemption is 11 million per person, do I still need the policy? Well, I had that question from a client of mine who's ready to make a $50,000 premium payment. He was, okay, now at 22 million, we're not going to need that policy that I was paying this high premium for. He was going to have the just take the cash surrender value from the policy. And I had to caution him and remind him that, you know, you set up this trust, it's an irrevocable trust, you're not going to get the benefit of those cash surrender, the dollars for the cash surrender value back in your pocket, because that goes to your children at some future date. So think about it before you cash in that policy. Also think about it that today it's 22 million per couple, but in 2026 it's going to revert back, and we're thinking it's going to revert back somewhere about 5 to 6 million per person, because it's 5.6 million adjusted for inflation. So by the time we get to 2026, the exclusion as we know it will probably be about 6 million per person, possibly 7. So if I don't need it today, will I need it in 2026? And in 2026, what will my health be? I might not be able to get a policy in 2026 or an affordable policy. So maybe I want to keep my policy I have in this ILIT. Maybe you want to just think about, can I just adjust the policy so that I can maybe have a paid up policy with a lower death benefit? That's what my client did with the $50,000 life insurance premium. He talked to his agent and adjusted it so he no longer has premiums owing. He just reduced the death benefit. So I caution people, don't act too quickly on some of these ILITs. Really think it through before you cancel something that you might need in the future. Another trust opportunity we're seeing, and I saw the same thing in 2012 when the exemption went from 5 million down to 1 million. People wanted to use that exemption before it was going to be reduced, but they didn't want to lose the income stream. We're seeing the same thing now where people have the $11 million exclusion. They want to use it now, but they don't really want to give up the income stream on 11 million. So what we're seeing some clients do is use their 11 million, transfer it to a trust for the spouse, let the spouse get the income stream, and as long as they stay married, they still get the income stream. So a spouse may take 11 million, put it in a trust, give the benefit of the income stream to their spouse, and at the death of that spouse, it'll go out to children, or possibly on divorce, it would go to the children. We saw a lot of this, like I said, in 2012, when the exemption was happening between 5 million and 1 million. I think I'm going to see a lot of it here now, when the exemption is at 11 million and might drop to 6 million. The caution I have there is they can't be identical trusts. You can't create them at the same time. They have to be different, and you have different reasons. Also, we've learned a lot from 2012 when we talked to clients and they're a happily married couple. It was no problem that they each gave their exemption into a trust for each other, but we're finding now sometimes things like divorce happen that aren't expected. Now, if you've divorced, you don't have that income stream from that trust I set up for my spouse, and we have to think about that. We're a little bit smarter, and we've added in language that provides for those divorce issues that come about. It is something you want to think about. Also, considerations for gifting. To take advantage of the higher exclusion amount, you have to use the lower amount first. So I can't use the top amount, that cushion between the 5.6 and the 11 first, and get the benefit of that. I have to use all of my exclusion of the 5.6, and then I get to that bonus amount we have from here to 2026. That was a misunderstanding some people had. They thought they could start from the top down, but you have to use your 5.6 million first, and then you get the bonus. Also, a big question when this first came about is what's going to happen when the exemption drops back down to 2026? Will they try tax me on that difference? Well, there's a proposed reg that says that will not happen. If you use the $11 million today for a gift, and I die on 2026 when the exemption is lower, the IRS will not collect tax on that difference, that differential amount. These are proposed regs. Of course, we're waiting for the final regs, but most national commentators are pretty comfortable that this is really going to be finalized. It also is comforting that if I have a death today and I have $11 million to make portable, if I port over $11 million and the second spouse dies in 2026 when the exemption is lower, they'll have at least my 11 million. My husband would have my 11 million, plus he'll have whatever his exemption is then in 2026. So number 10, what do we do with all the planning people have put in place? And maybe they don't need the planning now that you have $11 million of exclusion. Well, maybe there's things you've set in place to provide discounts. Many times in closely held businesses, if I don't have a controlling interest or a non-voting share or a limited partnership interest, for estate and gift tax purposes, you can transfer that on death or during life at a lower value. Because if it's only a limited interest, like a limited partnership interest or non-voting interest, the IRS says or has the position that someone might not pay dollar for that. So they allow you to take discounts on your returns, gift tax return or estate tax return. Well, now maybe I don't need those discounts. So maybe I want to change those planning documents to lower the amount of discount that might happen if I own a limited interest. If I had a family partnership or LLC, maybe I want to unwind that. And as I unwind that, maybe you want to think about, is there a way I can give the higher base assets out to my children? And me as a parent, I take the low basis assets. So when I die, I can get the stepped up tax basis on my lower basis assets coming out of that entity. For irrevocable trust, maybe you want to think about, do I need to change the trust now? If I set it up, especially you think about these credit shelter trusts, well, maybe I don't want it in a credit shelter trust now because my kids will not get the second stepped up tax basis on the second death. Well, the IRS has said you have to look at substance over form, and you cannot just not treat the trust as the terms are in place, or taint it, is how some people have phrased it. You'd have to do something to change that trust. So we're seeing a lot of people reform the trusts under state law, where maybe a state law may say if there's a tax purpose, you can change the trust if there's a change in the tax code. Or you can decant that trust, take those assets onto one trust and pour it into another trust that has better or more favorable terms for you and your family now that we have the higher exclusion. There's 26 states we have right now that allow decanting of trusts. They allow you to take the terms of one trust and pour it into another trust. You're taking it all from one trust into another, and that in every state, it's a little bit, there's 26 states that allow it, but they're all various forms of fashion and how their rules apply. So you want to think about that and maybe think about what state you'd want to have your trust administered in for the most favorable benefits for you and your family. Okay, I have a question here. If an ILIT is determined to no longer be necessary, can the ILIT distribute the policy to the insured or the insured owner's revocable living trust and avoid the transfer for value rules that may make the policy taxable at some point in the future? Well, the first step you're going to have to look at is what are the terms of that trust, because many times those ILITs are set up as irrevocable trusts. So I've made a completed gift into that trust, and the benefit of the principal asset in that trust is going to go to someone other than me. So first you look at the terms of the trust and how does that become distributed. It may be that it's not distributed until the last of the two spouses die. So my husband and I set up this ILIT. It's going to pay out to the children on my death. They have many years before something's going to happen. Here, if you're going to distribute the policy to the insured or the insured's owners, if it's the insured, that's back to me. How would that trustee even get that asset back to me? Now you're going to have some kind of gift element. If I've made a fully gift into the trust bought the policy to get it back to me. Now all your beneficiaries are giving it back to me. So that's a little bit a deeper question there. I think your first step is to look at what are my terms of my trust. You might have to change the trust agreement by decanting or reforming to even get to the step where you can get it back to the insured. Joe, we have a question for you here on credits.
Okay.
It says, are the NDOW Iowa credits affected by the SALT regulation that went into effect post-August 2018?
And the answer is yes. If you get a credit over 15% on NDOW Iowa, which you would generally do for a qualifying one, and your contribution is made after August 27th of 2018, your credit is affected. If you have carryover credits from contributions before that date, they are not affected.
All right, I believe that is the end. Do you guys have anything else?
No, I just want to thank everyone for joining Joe and I today. I hope we were able to answer your questions. If you have questions at a later time, Joe and I both have our email address there, our phone number. Feel free to give us a call.
Awesome.
Thank you.
Thank you guys. Everyone have a great day.